Always good to have you in the Lion City. So when you take a look at the AI play, given that China's AI players are much cheaper, valuations are way cheaper than the U.S., why wouldn't you be buying into China then try to keep on, racking up gains in the U.S.?
I think the rally certainly started in the U.S., but it has broadened out to areas like China because the applications around AI are really starting to expand. But let's not forget what's happening in the U.S. markets as well. The U.S. markets historically grew earnings at about 6 or 7% a year. And post-AI, since 2022, U.S. markets earnings EPS is growing at double digits. So we've grown from a market that's growing at 6 or 7% to now a market that's growing at 11 to 12%. And for the next 3 years, we think that earnings growth is once again going to be in the double digits. And so you've seen a little bit of an expansion in the absolute valuation in the U.S., but we think it's much more than justified.
The thing is, Nvidia disappointed. Was it a surprise to you? I mean, expectations were sky high. It was kind of bound to disappoint.
Yeah, look, the stock's doubled in a very short period of time, so expectations had certainly gone a lot higher. But I think it was a very, very good result. And fundamentally, the question around Nvidia is always what happens to the trajectory of CapEx from these levels, right? CapEx, remember at the beginning of the year, CapEx of the 4 major hyperscalers was expected to be around $280 billion. You know what that number is now? It's $360 billion. And so that's the single biggest KPI that's still impacting Nvidia. And we think that models are going to get increasingly more competitive. Hyperscalers are chasing after artificial general intelligence. They're not happy with standing still right now. They understand that this is going to be the biggest technology pivot that we've seen in our lifetime, and they want to be the leaders. And that race is not slowing down. And until it does, Nvidia is going to continue to be interesting.
The thing is, show me the money. If CapEx is so high, I want to see the returns. I'm not seeing the kind of returns that I should be seeing if I'm putting that much money.
Yeah. So you might start. So part of the reason why Alibaba has been so strong today is because they're actually starting to see the returns around AI as well. You're seeing a lot of consumer internet platforms
Not to the level that you're investing, though.
So one interesting stat that Nvidia put out over the last couple of quarters is that if you look at training versus inference workloads, inference is actually the monetization piece. Training is actually the building of the models, right? We're now crossed over to the point where more than 50% of the workload is on inference relative to training. And so you're actually getting to the point where monetization is increasing. And we're optimistic as we look into 2026 with things like the development of AI agents, the continued monetization of consumer internet platforms like Meta, Netflix, and Spotify. The reason why these stocks have been so strong is because they're using AI and leveraging AI to actually drive higher levels of monetization. So there might not necessarily be visible forms of ROI to us right now because enterprise is just getting started, but it's well underway.
But you can understand why people are beginning to think about it being a bubble, right?
Yeah.
Because of the surge in the stock prices.
Yeah.
I mean, you're optimistic about the future, but you have changed your mind before.
Yeah.
That DeepSeek moment did prompt you to reassess perhaps your position on Nvidia.
Yeah.
What would cause you to rethink again?
Yeah, look, I think what would cause us to rethink, and first of all, we've been talking about an AI tech bubble for the last 10 years, right? 2015, it's a bubble. 2016, it's a bubble.
It's just a bigger bubble, though.
And by the way, the reason why is because we had to start such a sharp correction down that this rally up has been so powerful that people are saying, hey, we need to be cautious. But if you think about 2025 in isolation, the Nasdaq is up 12%. Over the last 10 years, the Nasdaq has averaged about a 16% return per year. So we're really back on track to where it has been, right? And if you told me at the start of the year that the single most important KPI for AI trade is AI CapEx, and AI CapEx has gone from $280 billion to $360 billion, and now the trajectory going forward is many people think that it's going to be more than the size of the U.S. Department of Defense spending, which is crazy to think about. Then you got to think that the trade continues to have legs.
So how do you play this? I mean, you buy the dip?
Yeah, I mean, this is a period of digestion. So like stocks, anytime
every dip, buy every dip?
You buy every dip. But so you have to think about what's happening, and you have to really go into the mindset of these people that are the companies that are spending this large amounts of capital. So if you think about what Meta is thinking, Meta is just hiring engineers for $100 million per engineer. Is that because they're going to stop spending on AI tomorrow? No, you have to think about what they're chasing after. And the big goal of what they're trying to chase after is AGI. And AGI is trying to unearth something beyond what humans are capable of today. So how do we cure cancer? How do we solve climate change? How do we solve, like, are there aliens in existence, right? There's like things that human intelligence can't currently comprehend, and we're trying to move towards that AGI, and we're just cracking the surface on that, and I just don't see them slowing down in terms of that. So outside of any kind of big multi-standard deviation event where we lead to a big correction, I just think that the medium to long-term trajectory of spend is upward, not downward. And so for those reasons, I'd probably be buying a lot of the dips.
I'm a little bit nervous because I think there are risks there, and I guess risks are being underpriced right now. How do you hedge? I mean, you know, just in case you're wrong.
Yeah. So look, I think you have to think about it and one of the things about Goldman is what we try to pride ourselves on is trying to be humble. And anytime the fact pattern changes, we're going to change our opinion as well, right? At least the investing culture is that way. And so, you know, we're going to continue to look for signposts that maybe we are wrong on this.
Including, like what? What signposting?
So basically, anytime that we think there's indicators that the CapEx trajectory is slowing, think about it, that's the most important KPI right now in the whole AI CapEx trade. And so what we're going to look for is any indication that that's slowing down.